Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D? And welcome back.
Good morning, Will. You too. How's Florida?
It's busy. I don't know if you've been to the theme parks lately, but it's a mob scene. Feels like
really?
you're paying a lot of money to wait in lines. I mean, it's
Yeah,
beautiful.
You went to Disney
beautiful.
World. People don't know.
But, yeah, we were at Disney World and Orlando. We spent a day at each, and I made sure we were the first ones there, last ones out, because it was. I hate to keep saying month, but it was quite an expensive day. And it's food. It's every turn. You've got a child tugging on you that wants something because you're basically in a really pretty mall. That you're standing in line going a few rides, but it was fun. Kids loved it, and the house was great. Had a great pool. The facility had a nice pool, so it was fun. It was a good awesome vacation. I got to see my brother came in, his family from Costa Rica, and my mom came in from Tampa, so it was great.
Awesome. Well,
you want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And let me share my screen. Hope everybody had a great holiday coming back. And I do want to say, I might have to leave a little bit earlier today, so we'll see how questions come in. And Wednesday will be out, right? Well, so Wednesday we're not going to be here. Will and I both had our kids' knee injuries, so we're going to doctors, getting MRIs and stuff. And unfortunately, they're always in conflicting with these times. So we'll be out Wednesday.
It's amazing how hard it is to get a MRI done. Yeah, like you think someone injures a knee and they're limping, they can barely walk. It would be something they'd do right away, right? But
right away,
they give you X-rays right away. Call. I mean, I called someone; they were like a month and a half out. It was crazy.
Yeah, because my son had basketball injury, dislocated his knee. Your daughter, she was playing lacrosse, is that correct?
Yeah, it was lacrosse, and we still don't know, but it's probably there. Hopefully, it's a meniscus, but it could be an ACL. So,
so both of you trying to scramble, get MRIs done, see doctors. So Wednesday, we'll both be out. But if you guys are joining us for the first time and you have a question, be a Market Chameleon tool, data analytics, strategies, you can put that question into the live chat on YouTube. Will's watching it, he'll read it back to me. If you want to come on the show live and ask your question, we also provide a link to Zoom. If you click on that link, go over to Zoom. Once you're in Zoom, there's a button, raise your hand, click on that. You don't have to turn on your video camera. It'll prompt you to turn on your video camera, but once we invite you in, everybody will be able to hear you. You could ask your question directly. While we're waiting for some questions to pop in, we'll start out with the pre-market report, see what's trading in pre-market hours. After that, maybe I'll take a look at one of our option reports, see if we could get some insights from that. And if questions come in, we'll take those first. All right. So Let's start out pre-market report. These are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 54 stocks made our percentage gainers list, 113 on our percentage decliners list. From this perspective, right now, we're looking like a more bearish bias at the open. I'm going to filter down this list to only S&P 500 companies to see what's going on there. So we do want to take out low cap stocks, ETFs, leverage products, closed-end funds, preferreds. Let's remove all those to only look at S&P 500 companies. And to do that, I'm going to use the filter here in ETF, drop it down, and here we see a list of different ETFs. When you select one of these ETFs, the list below will get filtered by stocks that are holdings in that ETF. SPY, the first one, that's the S&P 500 ETF. Let's select that. When you do that, you see the list below here is showing us stocks that are holding of the SPY ETF, which are the S&P 500 constituents. And here we see 4 stocks made our percentage gainers list, 26 on the percentage decliners. So from here, we're getting a more bearish buy signal at the open. Of course, a couple things happen. I think the big one right now is that there's protests in China. Something happened over the weekend, that they have strict rules in place to prevent the spread of COVID. I think people were locked in their houses. There was a fire. Is that correct, Will?
Yeah.
And now there are big protests.
I mean, the fire is one thing, but it's, they're locked in because of their zero COVID policies. And people are starting to lose their stuff.
They're starting to lose their stuff. And the China right now is it's in probably a situation that, they're finding themselves in that they're not used to, because historically, they could have just ruled with an iron fist, come in there, break up these, protests and just force people back in there. But when it's the second world's biggest economy, with all these businesses investing in there, with all these countries doing business with them, you can't do that anymore, right? You're going to risk a lot to your economy, and it's how you handle these. You can't be as forceful, like, let's say, somebody in, like Iran, because Iran is much more isolated, so they're not as impacted by, companies and investments pulling out, trade wars and tariffs. And I think that when people are looking at these protests, they're getting a little bit worried, because the assumption is a lot of the stock market rally recently was that China was going to ease up, right, and open up their economies, and that's going to create, some economic support or strength. The Chinese market went up, our markets went up as well, and now we got that situation happening. So that's something to monitor, what's going on in China. But at the same time, well, they're going to ease up. What happens if COVID does spread, right? If more people get sick, and then they have, hospitals that can't handle it. So it's a bad.
Yeah, it's an interesting
bad situation. Really bad situation going on there. How did they control it? Let's see. Another thing before I move on to the next report, and maybe what I'll do is I'm going to come to this report here under options. We're going to take a look at how the straddles performed in we'll say like the S&P 500 stocks. And what it does is it tracks week to week. If you did a straddle in the beginning of the week, held it to the end of the week, what was the performance? Was it profitable, non-profitable? We could look back in history to see how implied volatility is behaving relative to the realized volatility. How much they diverge. So I think we'll start with this report. A couple other things that did come in, I wanted to mention. Over the weekend, we get, I get a lot of, like, sometimes emails with comments and a lot of people who might be even starting out with trading. Some people who have been trading, have seen some success, and then all of a sudden take a really big hit all of a sudden, which, we talked about, that shouldn't be happening if you're doing it correctly. And what I often see is that when people start trading, they always think of that they're getting into it and they're going to get this big windfall, like a lottery style. Once they invest, they're going to get this lottery style payoff, like this huge sum of money that's sitting out there. It's easy to grab, even though they didn't work for it, you didn't deserve it, but you're gonna get it. And then I get certain questions, where people ask me, like, give me a list of companies that are going to go up 20, 30, 100%, but let me know before that happens so I could buy them. And then once I buy them, then they'll go up 100%. And I need that list. And, there's, when I hear these questions, it's actually kind of sad, because it just shows how much like lack of education there is about like stock market and risk. It's like our education system doesn't teach people about investing, trading, and risk. And there's too much. Maybe the problem is, as I'm like reading these things, is that that when people think about getting into investment and trading, they don't think about, how am I going to be a good trader, right? They think about, how am I going to be right and make a lot of money. That's how everybody kind of starts to think. How am I going to be right and make a lot of money, and not how am I going to be a good trader? And what I mean by that, and I think maybe Mike Tyson even said this, but if you want to be a boxer, anybody could throw a punch, right? Anybody could throw a punch. It's how you take a hit, right? Can you take the hits? And that's how it is with trading. How do you handle the risk and losses? And you have to be prepared for that ahead of time, because it's inevitable. You cannot, that's part of trading, are losses, right? There are going to be losses. There's no way to trade without any losses. And it's how you prepare for them ahead of time and how you manage them. And that's how, in the preparation, when I talk about being a good trader, to me, a good trader has nothing to do with I'm right. Okay, I was right. Like, that's not a good trader. I was right. I made this forecast and I was right. That does not mean that you're a good trader, all right? Because there's no way to, accurately always predict and be right. A good trader is somebody who's efficient. Okay, that's what a good trader is. It's if you're an efficient trader looking for trade setups that, even if you're wrong, and your forecast was off and it went the other way, that you probably stood to make a lot of money if you were right. And if you were wrong, maybe you could even make a little bit of money or break even. And that would be an efficient trader, if you could start setting up things like that. If you could be short the market, that's what I was, if you could be short the market, having it go up against you, and breaking even, but stand to make a lot if it goes down, then you're starting to trade more efficiently, and that's a good trader to me, not making a right call, because you can make a lot of right, they're rich people and smart people, right? Very, with PhDs, but they're not the best traders, because otherwise all the rich people would be just PhDs, or the rich people would never make mistakes or lose money. But that's not, it's about being an efficient trader. That's kind of what I wanted to emphasize. And maybe, there's no way to teach that to somebody in a half hour or an hour. It takes a lot of experience, and we try to go over that. And I'll show you some examples of difference between being an efficient trader and an inefficient trader. Maybe I won't start today, but that's the difference. You know, and when somebody comes up to me and says, like, you know, well, Dimitri, you know, show me a list of stocks that, you know, are going to go up 100% so I could buy those. If that sounds normal to you, you know, to me it's like showing up to a golf championship game. You never played golf, you have no idea what golf is, but you said, just show me how do I hit a hole-in-one every time. Right? That's it. I just want to hit a hole-in-one every time, and just show me how to do that. You know, it's ludicrous to say that. You know, there's no answer even to, you know, because you're like, well, you have no idea then. You know, you probably never played this game, you have not enough experience, and you don't understand the rules. So, you know, it's important, you know, how prepared are you for the unexpected, the risk that it goes the other way? You know, how well are you set up, and how efficiently are you trading your portfolio? Okay. So, you know, let's move on. I just wanted to mention that, because I have been getting some emails, especially with the volatility we've been talking about. We're going to see a lot more volatility. I think that's what's, you know, right now people are feeling that volatility and getting run over by it. But let's take a look at this straddle. Okay, week to week straddle, and this report here tracks the options, like we were saying, from Monday. We take a snapshot at 10 a.m. We let Monday the options open up, let them trade so the spreads could squeeze in a little bit with the market makers and so forth, bringing in their spreads. We take a snapshot at 10 a.m. and then we track that option to Friday's close, and we see during the week how did that option perform. And we look at, and let's take a look at the straddle. So the straddle is taking the at the money options in the near term. So the nearest term option that covers that week, okay, and we take a snapshot of the straddle, the at the money call and the put. So if you're buying the call and the put, you're buying the straddle, which means that if you do nothing, the stock has to move by a big enough percentage to cover the cost of both the call and the put. And if you're selling it, you don't want it to move right by that percentage. So let's take a look first at that. The strategy is at the money straddle, right? And I'm going to look at, let's filter down this list to only S&P 500 stocks. So what we have here is, you know, Apple here, the symbol. And we look at the straddle from 3 different perspectives. I'll explain that. Here's Apple's market cap. This is sorted by market cap, average daily volume. This is the spread in the options, 4 cents. We set this to 12 weeks, the last 12 weeks of observations, and we have 12 observations. What this means is that in the last 12 weeks, we should have 12 observations, but sometimes we have less. And the reason we have less is that if our system detects that the markets are too wide or something is off where these options are not that liquid, that we can't get a sense of where the options really are, we'll just skip that observation altogether, because otherwise it'll just give us a skewed result anyway. Okay. So if you have an option that's no bid at $5 and it's always like that, there's no point because tracking it, because it'll be no bid $5 no matter where the stock goes. So those are not good observations. We've removed those. But in Apple, obviously, this one is very liquid. So we do have that. And then this goes through and tells us some of the stats for the last 12 weeks. So we have 3 ways we could trade that straddle. One is that You just buy the call and the put that's at the money, then hold it till Friday, and then Friday you close it out at end of day. Okay, so that's one way to do the straddle. Another way to do the straddle is say, okay, well, you know what? The straddle itself, it's not always exactly at the money. So the stock price doesn't always exactly equal the strike price. The stock could be below the strikes or above the strikes, because you could have $5 strikes, right? So you could have, $95 strike, $100 strike, $105 strike, but the stock could be at 98, right? Or 102 in between. And when that happens, one of the options has a bigger delta than the other. In other words, it's already a bias. It's not a completely neutral strategy. So if the call is more in the money, then you have a long bias, right? Because then the call is already worth more than the put. That means you want the stock to continue to go higher, because right from the onset, you have a long bias. If the put's in the money, then you have a short bias, and that means you want the stock to go down. So to offset that, what we do is hedge the strategy with stock to make it delta neutral, making it that there's no more long or short bias. Okay. Then the other way to trade the straddle is delta neutral, because the straddle itself can start off as neutral, right? So the stock's at 100, you buy 100 strike call, 100 strike put, meaning you don't have a bias. It could go either way. But, you're waiting till the end of the week, and every day can move around. So some days it could go up, and all of a sudden you have a long bias, and then it could go down the next day. You have a short bias. So it could move around. That's called volatility. And you could trade that volatility against the stock. So the options are the implied volatility. Hedging the stock, your delta, is the realized volatility. And that's another strategy, because you're rehedging your position. And in our case, we're rehedging it at end of day every day. So we're consistently using end of day delta, rehedging it. The next day, we have a new delta, we rehedge it. We do that till Friday, and then we measure which strategy performed best, right? Would we be better off just buying the straddle, leaving it alone, buying the straddle delta neutral, or rehedging that straddle on a daily basis? So this is what we could compare the three different approaches to see, well, what was better, right? And here we have a few different metrics to look at, right? One is, if we just used Apple as an example, the first metric is, well, which one was tended to be more profitable, more frequently profitable. Okay, so this isn't looking at the profit, but just looking at, out of the last 12 observations, how many times did this strategy end up making a profit? How many times did this strategy end up making a profit? How many times this? But that's only one metric. But here we see that the unhedged and daily hedging tied there. So 42% of the time. Okay. What about, on average, what was the return week to week? So if you reset that strategy every week, right? You start the beginning of the week, and let's say you risk $1,000 in notional. By the end of the week, you get out. Then Monday, again, you reset it, $1,000 notional. By the end of the week, you get out. So you kept the original risk consistent, right? You got out, reestablished at new prices, $1,000 notional. So here we see this one did it slightly better. On average, it gained 16%, while these two on average gained 14% last 12 weeks. So far, nothing special. I would say they're all pretty much tied. What about the median return? So this is the average. And of course, the average return, if you work with simple averages, when you have a big outlier, it will pull up the average. So you could have one instance, right? Just out of 12 observations, you could have had one instance that was really large, and that pulls up the average. So we could compare the median returns, and the median returns are saying it doesn't matter. It's not averaging them out. It's listing out all the 12 returns and saying, what was the return right in the middle? So here we see that this one was -8%, -22, -19. So right now, this one kind of sticks out a little bit because now we're seeing the median return. If we didn't have like a couple big ones, the median return here, even though it's negative, it's not as bad as this one and this one, right? Then let's look to the next metric, right? And all these metrics you have to, take into consideration, kind of mutually and inclusive and exclusive, right? But they all tell us a little bit something different. Sometimes I get questioned, well, which one should I just look at? Well, there is no one just to look at. If there was, we wouldn't list all of these out for you, right? Why would we put all these in here if it was only one thing to look at? All of these are telling us something different, right? And all these are giving us different information that should be considered in your overall evaluation as an input to your decision making. So the next one is a standard deviation. And what this is telling us is, okay, we have this average return and median, but there are 12 observations. And how much do the returns from week to week deviate from the average, right? So, for example, if every week it was exactly 14%, every week if it was exactly 14%, that means there's no standard deviation, right? It doesn't fluctuate. Just I could expect 14% every week. But that's not the case here. Sometimes it could be negative. Sometimes it could be a really big positive, So even though 14% is the average, we may not even ever hit 14%. The 14% is just the average. So it made net out of the 12 weeks, and I could click on it and see over here, there was no 14. You could see that the returns fluctuate a lot. We had plus 146%, minus almost 50%. So there's a big volatility to these returns, right? That's something to consider. Like, wow, I could be down, this week I could be down 100%, or I could be up 150%. That's what this is telling us. That's how we start evaluating, these different types of, strategies. And you have to, come look, even here, what is this? This is telling me that even though these are very volatile returns, they fluctuate a lot, this one is much lower than this one for the same return, right? So I'm smoothing it out here. The volatility of my returns are not as high. Even though they're high, they're not as high as this one for the same return. So this would be, from a historical perspective, a more efficient strategy than this. Guys, we're right up at 9:30, and I got to go because our MRI's today, and then I'm seeing the doctor Wednesday. But
all right, D, you get out of here, buddy. Great job. That was awesome.
All right, everyone. Thanks for joining. Hope you guys have a great trading day, and hope to see you guys tomorrow.
All right, have a great day. Good luck at the doctor, D. Everyone, thank you for joining. We'll see you tomorrow. Have a great